If you're like most Americans, your home is both your biggest asset and your biggest liability. I'm going to take a few minutes to do a high-level overview of a product that will maximize real estate as an asset while minimizing the liability. Why is it important to consider alternatives to traditional mortgage loan? Well, this chart says it all. Traditional mortgages are front-loaded with interest costs. Money only flows one way, with the bulk of interest being paid first. In fact, 50% of the total interest is paid in the first 10 years. We know historically that most mortgages are either refinanced or paid off because the property is sold in the first 5 to 7 years. Then you get a new traditional loan and the cycle starts again. People stay stuck in that early portion of the amortization schedule, paying a lot of money in interest. The bottom line is even a low rate loan charges a high amount of interest in traditional products. What if I told you that there is a product that accelerates the pay down of principal, lowers monthly and lifetime interest without depending on lower rates, and provides the homeowner 24/7 access to their home's equity? Sound too good to be true? Well, I'm excited to say that it exists. The all-in-one product is a lifestyle product as much as it is a loan product, and it was created keeping typical cash flows in mind. Money that flows through your bank account can often sit idle for months, waiting for a certain bill to come due. You probably buy groceries weekly, but you pay your cell phone bill monthly, and you pay your property taxes twice a year. Interestingly, most people flow more money through their bank account in the course of 5 years than they actually owe on their mortgage. The all-in-one allows you to keep your money working for you by combining your mortgage with a bank account that comes complete with ATM and debit cards, checks, and all of the other handy banking features we've come to love. In this way, you can substantially reduce the time it takes to pay off your mortgage without impacting your lifestyle and while never losing access to the funds. Let's look at an example. Say you're purchasing an $800,000 primary residence and need to finance $640,000. We'll compare this to a traditional 30-year loan with a fixed rate of 6%. Remember, this is a lifestyle product, so it's important to look at the large picture of cash flow and not just income. In this case, you regularly net and deposit close to $12,000 a month, and you spend $9,000. So let's walk through a couple of months. The very first month, you get this loan, which starts at $640,000 loan balance. You make a deposit. What actually happens is cash is converted to home equity dollars. Deposits transfer or sweep directly to the all-in-one line of credit, and all of those dollars are applied directly to loan principal, paying the balance down that day. Now interest is recomputing. So of course, we continue to save even as we spend. You spend regularly, just like you normally do. Interest is recomputing nightly. What occurs here is you end the month at a lower balance than you began, naturally, without any budgetary changes. This is why it accelerates the payoff. Month number 2 begins, another deposit, more spending, and the red dot represents the interest payment for the month number 1, which occurs on the 21st of month number 2. This goes through months 3 and 4. After 4 months, the principal balance is reducing dramatically. What is achieved in 4 months with the all-in-one product would have taken the 30-year mortgage 12 months. And that 30-year loan doesn't keep your money liquid for use. Long-term results are pretty dramatic. It's mind-blowing to most folks to see how they could save and how powerful their income actually is. I love that about this product, that people can awaken to the fact that they have all the tools it takes to reduce the time and debt and save more. You have everything you need except the mortgage, and we can put that in place for you. In this example, the loan would be paid off in 15.8 years and save you $272,000 in interest costs when compared to the fixed loan. This is a dramatic shift in financial health and was achieved without adjusting spending habits or limiting lifestyle. If you would have taken part of that $3,000 difference in income and expenses and paid it to your traditional mortgage, you may have paid it off faster, but it would have been locked up and you'd have had no access to it. The amazing thing is, getting your mortgage paid off faster isn't even the best part of this product. Because it's a first position HELOC and the most flexible loan in America, You maintain access to the equity in your home because the loan is designed to reach zero balance by the end of 30 years. The equity available steps down in this way. The credit limit established remains unchanged for the first 10 years, meaning you can write a check up to that credit limit. But after those 10 years, the credit limit will begin to reduce automatically and evenly each and every year to help drive down the credit limit so it reaches zero at the end of the 30th year. As an example, if the original credit was $500,000, you can see how the available limit begins to reduce after the 10th year. But it also provides a significant amount of liquidity all the way through payoff. Now, anything in between the daily loan principal and the credit limit remains available for your use 24/7, all the way through. Just think of all the reasons and all the ways you can use this loan. All that equity at your fingertips without having to go through the hassle of getting a new loan. If you've made it this far, I'm hoping I have your interest. I'd love to set up a time to go through the product in more detail and to share the calculator that will help determine if the product is right for your situation. Thanks for watching, and I look forward to speaking with you.